Good morning. My name is Thea, and I will be the conference operator today. At this time, I would like to welcome everyone to the Unlocking the Value of New Technology Single Aisles Conference. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw the question, press the pound key. Thank you. At this time, I would like to turn the conference over to Mr. Steve Mason. Please go ahead, sir.
Hello, and welcome to the CIT Commercial Air webinar titled Unlocking the Value of New Technology Single Aisles. My name is Steve Mason, and with me here today is Jim Morrison. We are both members of the Aircraft Evaluation and Asset Strategy team here at CIT. We'll move on to slide 2. So from time to time here, we publish research papers, which we call executive insight pieces. Topics of these papers have included regional market analysis, aircraft economics, aircraft strategy, and airline surveys. All of these papers are available on our website. As mentioned, today's topic is unlocking the value of new technology single aisles, and it is our most recent paper. Jim and I will now take a second to introduce ourselves. So as mentioned, my name is Steve Mason, and I run the Aircraft Evaluation and Strategy team, and I'm based here in New York. The team is responsible for new aircraft investment analysis, market analysis, aircraft economics, aircraft strategy, and the all-important aircraft values. A large part of what we do is supporting and supplementing our airline clients' analysis and decision-making. I joined CIT in 2012, and prior to that worked for an engine manufacturer, Rolls-Royce, in various disciplines, including aftermarket business management, strategy, and eventually sales. Over to you, Jim.
And I'm Jim Morrison, the handsome fellow to the right of your screen today. I joined CIT about a year ago now, coming from Bombardier Commercial Aircraft previously, holding marketing and strategy positions.
So we'll move on to slide 5. Before we get started, this is how our webinar will run today. Jim and I will lead you through a presentation which we expect to last about 25 minutes. We will then open up the lines for questions. So today you will also have the ability to send in your questions via your WebEx screen. Instructions on how to do this should be on your screen right now. For those of you who do not have access to WebEx right now, please see slide 5 of the deck we emailed to you. To send a question, simply click Chat on the top right of your screen, select Jim Morrison Presenter, type your question, and press Enter. When typing, please be specific with your question, which will enable us to best answer you. Only we can see your questions, so they are private. As the operator explained, she will instruct you again on how to use the phone line to ask a question at the end of our presentation. So now let's get started. So moving on to slide 6, our executive summary. So I'm sure many of you decided to register today because of the significant drop in oil price, which has forced you to question the value of new technology aircraft, whether they are clean sheet designs such as the C-Series or re-engine variants such as the A320, the 737 MAX, or E2 Jet. When the airframers came knocking on our doors over the last 5 years selling new technology single aisles, it is true to say that the majority of their story was aligned to fuel savings. In fact, at $100 per barrel, fuel overshadowed a lot of the other benefits of the aircraft. Now, with fuel prices moderating to a lower level, the shadow has receded somewhat to reveal other areas of value. An important part of the benefit of new technology aircraft is revenue. Later in the deck, we will focus on a couple of aspects associated with the revenue advantage. In our fourth bullet here on slide 6, we talk about utilization. The fact is, utilization is a key part of the value assessment in aircraft economics. Our analysis shows us clearly that new technology aircraft have value at any fuel price if you have high daily utilization. Later in the deck, Jim will demonstrate this. High growth and high utilization airlines can close the business case for new technology aircraft at almost any fuel price. Now we'll move to slide 7, and I'll hand over to Jim to take you through the first section of our presentation.
Thanks, Steve. The chart in front of you now shows a historical timeline of jet fuel prices on the spot market. So the vertical axis, you see the jet fuel price, and in the horizontal, the dates for the past decade. The bars at the top show the launch dates of the various new technology single aisles over the past decade, with an arrow pointing towards their EIS or expected EIS. What we can see is that when Bombardier launched the C-Series, Airbus the A320neo, Boeing the 737 MAX, and Embraer the E2, fuel costs were at the forefront of the manufacturer's mind. Jet fuel peaked at over $4 per US gallon in July 2008, and by 2011 appeared set to stabilize at more than $3 per gallon indefinitely. The manufacturers focused their marketing efforts on one prime advantage, and that was fuel cost savings. These aircraft are now entering service at a time that fuel prices have dropped sharply, in the range of $1.25 to $1.50 per gallon in 2016. But it's important to remember that aircraft do more than burn fuel. New technology creates revenue opportunities, reduces non-fuel operating costs, and enables airlines to build sustainable business models, gaining competitive advantage by doing things differently than they've done in the past. Our next chart on slide 8 shows a correlation between passenger yields and jet fuel prices. Passenger yield is the unit revenue that airlines collect for passengers flying a mile, whereas jet fuel is the year-over-year change on the right axis of this chart. And what we all know is that jet fuel prices are volatile. In fact, if you look at the frequency of jet fuel prices year-over-year changing by more than 30% up or down, and compare it to the S&P 500 stock market, jet fuel is 4 times more likely to have these dramatic changes in prices. But airlines have become exceptionally capable at managing these volatile fuel costs. And pricing is the airline's strongest tool. By dynamically pricing seat inventory to reflect changes in costs, airlines mitigate their exposure to fuel price fluctuations. And that's what this chart shows. With a 0.93 R-squared over the past decade, there's a strong correlation between changes in passenger yield and changes in jet fuel prices. In fact, the 0.93 R-squared has a stronger correlation than the oft-cited relationship between growth in passenger traffic and world GDP. While changing economic and competitive environments make it challenging to fully offset sudden changes in fuel prices with revenue, this relationship shows that on an industry level at least, airlines have been highly successful at adjusting passenger yields to track jet fuel price changes. Of course, airlines can opt to have financial instruments to hedge their fuel price exposure as well. This provides greater cost certainty over their planning horizon, but we all know that hedging costs money. In fact, depending on the hedging strategy, the cost of hedging one single-aisle aircraft could range from $15,000 to $50,000 per month, which makes one question the benefit of paying to place bets instead of paying for the sure bet of new technology. Shifting to slide 9, we see a chart that we've seen many times around the industry up to this point. And it shows on the vertical axis the expected fuel cost savings per month of a new technology single aisle over a current generation, with the fuel price varying along the horizontal axis. So clearly, as fuel price goes up and to the right, the cost per savings of a re-engined or new technology aircraft goes up. But the inverse is true as well. As fuel prices go down, the fuel cost savings per month decline. Given today's fuel price expectations, airlines are planning for roughly $30,000 to $40,000 per month of cost savings for new technology single aisles. But there's an inherent flaw in this worldview. And we show that on the next slide, number 10. Because not all airlines value fuel efficiency the same. Fuel cost savings per month is dependent on the price of fuel, as well as the amount that you fly the aircraft. So this chart shows the same line that we saw on the previous chart, but varies the daily utilization, the hours per day that the airline flies the aircraft, and shows that if you fly the aircraft 6 to 8 hours a day, you have a dramatically different fuel cost savings per month than if you fly the aircraft 10 to 12 hours per day. A network carrier generally keeps the aircraft on the ground longer at the outstation, timing its arrivals at the hub's banks, resulting in a lower utilization than a low-cost carrier is able to with a point-to-point network that's not constrained by timing connecting itineraries through a hub. So it's our hypothesis that different airline business models place different values on the fuel cost savings of new technology single aisles. So in slide 11, we see a slightly more complicated view, but maybe a more accurate worldview, that shows on the horizontal axis the utilization or hours per day that the aircraft flies, and on the vertical axis, the jet fuel price. The color codes shows the expected monthly contribution of a new technology single aisle over a current generation, with red having a negative business case, i.e. the ownership cost increase of a new technology aircraft exceeds the fuel cost savings, and the green, showing increasingly darker shades towards the upper right corner, shows a higher profit contribution of a new technology aircraft. So this chart shows that airlines that fly fewer than 6 hours per day may not benefit from a new technology single aisle in the current fuel price environment. But an airline that flies 10 to 12 hours per day closes their business case for new technology at almost any fuel price. The airline's business model is a key driver in determining the value of new technology will bring to the operator. As we flip to slide 12, I'll transition back to Steve.
Thanks, Jim. So as I mentioned at the beginning, one key area of value is revenue. The revenue advantage of these new technology aircraft is driven, in our minds, by four major items: more range, better performance, less noise, which leads to improved airport access, and efficient cabin seating, seating more people in the same space. I'll talk about range in the next slide, but right now would like to quickly comment on cabin efficiency and aircraft performance. So cabin efficiency, I'd like to use the A321neo as an example of this. When Airbus introduced their ACF, which stands for Airbus Cabin Flex modification, the maximum seating capacity on the aircraft will be 240 passengers. This cannot be replicated or retrofitted on the A321ceo. So an airline will have up to a 10-seat advantage in the same exact hull. The revenue advantage of 10 seats for a standard mission can easily equate to $1 to $1.5 million per year for an LCC operator. The fuel cost to fly these additional 10 passengers per trip is approximately $50. Better performance. So the better performance of the new technology single aisles is driven by a couple of things. For example, on the A320neo, which is already in service, Airbus have improved aerodynamics, engine, and control laws to enable better performance. There has also been a 3 to 7% thrust increase versus the ceo. So when you're takeoff weight limited, the A320neo can take off with 15 to 20 more passengers compared to the A320ceo. This is a real revenue advantage. So just turning to the cost side for a second, I'd like to focus on noise charges. While restrictions reduce revenue opportunities, and I will discuss the flip side of this in a second, noise charges increase the cost of operation. Airbus estimates that an A320 with 2 landings a day at London Heathrow will save $60,000 per month over the A320ceo, just on lower noise charges. So let's put that $60,000 into context. An A320neo operating a standard mission will burn approximately $450,000 of fuel per month. So this noise saving alone is equivalent to a 13% reduction in fuel burn. It really is pretty staggering. Moving on to slide 13, let's focus on the revenue side for a second. So what we've done here is look at routes between 3,000 and 3,500 statute miles with a more than daily twin aisle service, but with no single aisle service today. As the range of the single aisles increase to the higher end of this range, we will see plenty of opportunity for single aisles to replace twin aisles, which may be economically less efficient on these routes. Think about how the 737NG and the A320ceo changed the landscape of U.S. East Coast to West Coast flying. This chart does not include routes where there is no service today. And think of the possibilities from the East Coast of the U.S. to Western Europe and vice versa, something that TAP and Norwegian are thinking about. We suspect operators such as Delta, JetBlue, American, United, Aer Lingus, etc., the list goes on, will look to these new single aisles to exploit their revenue opportunities. The Norwegian CEO recently commented that the 737 MAX will have even lower cost than the 787 Dreamliner per seat. CIT's proprietary aircraft economics model tells us that he is 100% correct. Moving on to slide 14, noise. So the smaller noise footprint of new technology single aisles will enable access to certain airports previously only served by turboprops, but will extend curfews. 128 airports that account for about 15% of scheduled passenger takeoffs worldwide have implemented noise charges. An additional 181 airports have curfews or other type of noise limits. So in all, 32% of departures in the world today are from airports with noise restrictions. So now we will move on to the next section where Jim will help us understand the types of airlines that will value new technology the most. Over to you, Jim.
Thanks, Steve. Please continue sending your questions via the chat function, as after we're done this section, we'll open it up for a question and answer session. So this chart outlines an analysis that we did in the white paper to better understand which types of airlines value the new technology single aisles. And there's a natural experiment unfolding in front of us. That is the transition from the current generation types to the new technology types over the next 4 years, from 2016 to 2019. We used a business model segmentation methodology based on the utilization, the hours per day, that single aisle operators were flying their aircraft in 2015, and their growth rate, the single aisle fleet growth rate from 2012 to 2015. We provided some thresholds to segment the market roughly equally into 4 quadrants. And those 4 quadrants were defined by the high utilization, low utilization, and the high growth and low growth. So within that 4-year window, we have a roughly even split between the forecasted deliveries of new technology aircraft as well as current generation. And those airlines operating more than 8.8 hours per day and less than 8.8 hours per day in 2015, and with growth rates more than 6.1% and less than 6.1%. So in each of our 4 quadrants, we have roughly the same number of forecasted deliveries over the next 4-year period. There are some limitations in the analysis. Our assessment of airline growth and utilization is retrospective, not prospective. We excluded unplaced lessor slots and forecasted deliveries to unannounced customers. And the timing of deliveries is challenging to forecast without inside knowledge of the OEM skylines. But nonetheless, we feel the results of this natural experiment yield some interesting insights to how airline business models value the new technology. Moving to slide 16, we see the results. Starting in the upper left quadrant for the high growth carriers with high utilization rates, the results of the study showed that 2/3 of these carriers are accepting deliveries of new technology aircraft in the time frame of interest. Moving clockwise to high utilization carriers with low growth rates, we still see a preference for the new technology types, but a weaker preference with 55% of forecasted deliveries for the new tech types. To the lower left quadrant, the low growth carriers with low utilization are essentially indifferent in the technology selection, with a split of 50-50 for both the current generation types and the new technology. And the upper left quadrant, the high growth carriers with low utilization, show a preference for current generation types, with only 40% of deliveries forecasted to be new technology and 60% for current generation. On slide 17, we outline some of the potential or possible rationales for these trends in the technology preferences by the airline business models. As shown earlier in the presentation, the business case for new technology closes at almost any fuel price if the airline flies the aircraft enough. So it's not surprising that the right-hand side of the chart, for the high-utilization carriers, have a preference for new technology aircraft. High-growth carriers are growing their networks and are likely more able to take advantage of the new network and revenue opportunities that Steve discussed that the new technology aircraft bring. The low-growth carriers are generally more mature, using their new aircraft deliveries to renew aging fleets, and are more likely to slot the new deliveries into existing network structures as opposed to open new routes, placing potentially less value on the increased payload range capabilities of the new technology, but still showing a preference for new technology given the high utilization and strong business case for these types. In the lower right quadrant, the lower left quadrant, for low growth carriers with low utilization, we see an indifference with roughly 50-50 split between the generations of technology single aisles. With fewer flying hours per day, it makes sense that the business case for new technology may not be as strong as for the high utilization carriers. And with more mature carriers focusing on replacement demand, they may be slotting these new deliveries into existing network structures. The upper left quadrant, the high growth carriers with low utilization, are showing a preference for current generation types. This may be because these types are available sooner without the complexity of integrating the new type into a fleet, and so growth can be fueled with the current technology types before switching to the new technology later next decade. On the next two charts, we break out the segmentation showing by region on slide 18 and by airline on slide 19. So this chart shows the utilization per day along the horizontal axis and the average fleet growth rate along the vertical axis. The size of the bubbles shows the forecasted number of deliveries over the next 4 years, and the color coding is showing the preference for technology types, with green representing a preference for new technology, blue showing a somewhat indifference, somewhat of a 50-50 split between the current generation and the new technology, and red showing a preference for current generation types. We can see Middle East operators with deliveries in our time frame have the highest single aisle utilization, and 61% of deliveries this decade are forecasted to be for the new technology types. For European operators, while they're the most exposed to noise chargers, as we saw on the previous chart, they have a lower average utilization and in fact are somewhat indifferent between their technology selection in aggregate. Asia Pacific has the fastest growing single fleet and has a lower average utilization than some of the other regions. And only 54% of deliveries will be for new technology. Latin America has bet heavily on the new technology types, which account for 78% of the operator deliveries this decade. Whereas North America has a lower share of the major regions, with new technology types accounting for only 43% of forecasted deliveries, demonstrating a difference in the airline fleet planning strategies in this region. Slide 19 replicates the same chart as the previous one, with utilization along the horizontal axis, fleet growth rate along the vertical, and our 4 quadrants segmented with the lines, but shows individual airlines. To save your eyes some of the trouble, I removed the size of the bubbles for the size of the order books this decade, but have kept the color coding, with green showing a preference for new technology, blue somewhat indifferent, and red a preference for the current generation types. So due to the variety of fleet plans and differentiation of airline business models, trends are harder to discern here, but there are still some differences that we can see between rivals' business models that are interesting to compare. So if we look first at Indigo from India and AirAsia from Malaysia, we see an example of 2 rapidly expanding low-cost carriers who are high utilization operators and have a large share of their deliveries this decade to be new technology types, which would align with our previous hypothesis. Focusing on mature low-cost carriers, such as Ryanair and Southwest Airlines, they're generally in the lower right quadrant as a lower growth carriers, but with still high utilization rates. But both these carriers are focusing on current generation types to renew their fleets before accepting delivery of large orders of new technology next decade. As discussed previously, network carriers generally have lower utilization than low-cost carriers. If we look at the U.S. network carriers, they're generally in the bottom left quadrant. We can see that Delta's fleet strategy diverges from some of its U.S. mainline competitors as it focuses on current generation types, while United American have more balanced fleet plans with a mix of both current generation and new technology aircraft delivering this decade. From Europe, we look at Lufthansa and British Airways, which are both focused on new technology single aisles, whereas Air France has yet to commit to a new technology type. And finally, looking at the upper left quadrant, we see several Chinese carriers that are relying on current generation types to fuel their rapid expansion. They generally have lower utilization than some of the other carriers discussed, but are growing fast with these current generation types. And now, continuing to slide 20, I'll pass it back to Steve to wrap up our prepared presentation.
Thanks, Jim. So to conclude, it is clear the value of new technology goes well beyond fuel burn. In our view, new technology aircraft will appeal to most airlines, especially those with high utilization, airlines looking to develop new network structures, and airlines operating from noise-restricted airports. Of course, we shouldn't forget current technology aircraft. As investors, we need these aircraft to achieve their original business case, and indeed they are. For example, they meet the needs of these lower utilization carriers. Lessors will play a significant role in supplying new technology single-aisle aircraft. 213 A320 operators do not have an A320neo order of any description. That is 77% of the operator base. 255 737NG or Classic operators do not have a 737 MAX on order. That equates to 85% of the operator base. These are really staggering statistics that show the future demand profile for newer technology aircraft. What you pay for new technology aircraft is key, but for airlines, timing can even be more important. Operators can build a competitive moat with these aircraft and have first mover advantage. So that concludes our presentation and comments. We will now hand over to the operator to solicit any questions from the phone lines. Remember, at any time you can use your WebEx screen to type a question, which is private. Instructions on how to do this are on slide 21. Over to you, operator.
At this time, I would like to remind everyone that if you would like to ask a question, to press star 1 on your telephone keypad now. Again, ladies and gentlemen, that's star 1 for questions over the phone line. We'll pause for just a moment to compile the Q&A roster. And again,
okay, operator, while you're doing that, we have had some questions come in on the WebEx. So unless there's any questions on the phone line, we will start with some of those questions.
There are no questions over the phone line, sir.
Okay, so first question that came in is, why haven't you included twin aisles? Is there a value story with low fuel prices? Jim, any views on that?
Absolutely. So we feel there certainly is a value story with twin aisles. And actually previously in 2016, back in March, we did release another executive insight paper about some of our views on the new technology twin aisles that are entering the market this decade. So the story with twin aisles is similar, but the increased payload range capabilities opens new route opportunities that previously were only accessible with larger aircraft. This will enable fragmentation of passenger flows. So instead of having to connect passengers to large hubs, airlines are now deploying 787s as well as A330s and 330neos in the future onto thinner markets where they can connect passengers directly to their final destination without having to stop in a hub. We do feel that the size of twin aisles is a big influence on the value of the aircraft from an investor's standpoint, where smaller twin aisles that are more liquid, have larger operator bases with more units in service, provide more liquid assets for lessors and investors, whereas the larger aircraft will play a very important role in airline networks, are less of an investable asset. And that's why CIT has large orders for both the 787, A330neo, and the A350 aircraft. So if anyone would like a link for the paper that we released last March, we'd be happy to share that. Please feel free to send us a note.
Okay, thanks, Jim. We've had another question come in on the chat regarding slide 20, and the question is about have we done a similar sort of segmentation and analysis for lessors? You know, is there lessors that prefer to have new technology aircraft or used technology aircraft? So why don't I take that one? I think it very much depends on the shareholders of the lessor. Bank-owned lessors may chase better airline credits, and so might mean that they lean towards big airlines that have new aircraft, new technology aircraft on order. Certainly, we're seeing Chinese lessors add a lot of new technology to their order books and in the sale and leaseback market. And in their minds, obviously, they're trying to invest in dollar-denominated assets. These higher, ticket price aircraft, new technology versus used current technology aircraft, allows them to build volume a lot quicker. So it's easier to grow with higher ticket price new technology aircraft than it is with used current technology aircraft. Okay, we have another question here that's come in, probably one for you, Jim. Do these more capable single aisles hurt the twin aisle market? Don't we need less twin aisles because of these new technology single aisles? Yeah, so we do see aviation as a growth industry. Since 1980, on average, the passenger miles flown have grown by 5.5%. So in a growing industry, there's going to be demand for both single aisles as well as twin aisles well into the future. So we do see that, as Steve had shown before on one of our slides, as single aisles range capabilities increase, there'll be an opportunity for airlines to optimize how they deploy their aircraft. And so it may be that single aisles are more efficient to fly on some of these long, thin routes than deploying twin aisles through a hub than it has been in the past. So there may be some transition of narrow-body flying that used to be maybe 3 times or 4 times a week for a twin aisle to be daily service with the single aisle. But that will actually free up twin aisle aircraft to be deployed on longer haul missions, better using those aircraft closer to where their design point is on the payload range diagram. So we're thinking that twin aisles that are best, will continue to be best suited aircraft to serve large airports that are slot constrained, to feed into mega hubs such as Emirates does through Dubai, and perform the long haul missions that are outside the range of single aisles. So in a growth industry, optimizing deployment of assets is going to be the best thing for the airlines, improving profitability and making sure a sustainable business model well into the future. Okay, we're having a little bit of technology problems here, speaking of new technology, with our WebEx. So we have lost our question screen, but we have recorded some of the questions that were asked during the presentation. So we'll continue now. If you do have a question, please remember *1 on your phone lines. One of the questions that's come in is, what is our view of the 737 MAX 9? So let me take that one. So when we go out and speak to airlines, which we do all the time in order to feed our investment analysis for aircraft, airlines tell us they love the 737-900 today. We think the 737 MAX 9 will have a great future and even a better future than the 900. Airlines love the additional seats. The trip cost difference between an 800 and 900 is minuscule, and all of those extra seats really turn into additional profit. We're seeing certainly upgauging theme continuing in the marketplace. We don't see it slowing down, and this will take a lot of people from a 737-8 or a 737 MAX 200 into a 737 MAX 9. So we're optimistic about the 737-9. As a leasing investor, we do look at the investment thesis differently to an airline investor. We look at liquidity in the marketplace, the number of operators, and we'd like to see more and more operators take the 737 MAX 9, and we think that will happen. We'll see upgauging from the 737-8 MAX. Operator, any questions on the line?
There are no questions at this time, sir.
Okay, so we have no further questions. Apologies if you have not been able to type a question on WebEx. As I said, you do have the opportunity to press *1 on your phone to ask a question. But failing that, we thank you for your time today. We will release additional papers. Probably in the first quarter of next year, we'll release a new paper, and we'll hope to do a WebEx on that. Okay, so that concludes our call. Thank you very much to everybody for joining.
Ladies and gentlemen, thank you for participating in today's conference call. You may now disconnect.